Hey everyone, welcome back to Corporate Decoder, the place where we turn complicated corporate filings into something you can actually understand. Today we're diving into a Form 8K from Antares Private Credit Fund. Now, I know what you're thinking. Credit fund sounds boring, but stick with me because hidden in this report are some interesting tidbits about distributions, debt, and a continuous stock offering that could affect investors. First off, this is a Form 8K which companies file to announce major events. It's like a corporate breaking news bulletin. In this case, Antares Private Credit Fund filed it on April 4, 2025, but it contains important information from as early as March 31, 2025. One of the key announcements is about distributions. The company declared both a regular distribution and a special distribution for its shareholders. The regular distribution is $0.02113 per Ceres per share, and the special distribution is $0.201925 per share. So if you own shares as of March 31, 2025, you're entitled to that money, which they will pay out around April 30, 2025. You're entitled to that money, which they will pay out around April 30, 2025. You're entitled to that money, which they will pay out around April 30, 2025. You're entitled to that money, which they will pay out around April 30, 2025. You're entitled to that money, which they will pay out around April 30, 2025. You're entitled to that money, which they will pay out around April 30, 2025. You're entitled to that money, which they will pay out around April 30, 2025. You're entitled to that money, which they will pay out around... Now, let's talk about the net asset value or NAV per share. This is essentially the per share value of the company's assets minus its liabilities. As of February 28, 2025, the NAV per share for the Class I common shares was $25.12. Think of it as what each share would be worth if the company sold all its assets and paid off all its debts. Here's where it gets more interesting. As of the same date, February 28, 2025, the company's total NAV was approximately $638.1 million. They also had loan commitments of about $1,318.8 million. Loan commitments are agreements to lend money in the future. This means they've promised to lend out a significant amount of money. The company also had about $310 money in the future. This means they've promised to lend out a significant amount of money. The company also had about $310 SIF in dollars, bobbers approximately $60.38 million. This is where we need to put our Warren Buffett hat on. A crucial metric is their debt to equity ratio, which was approximately 0.49 times. This means for every dollar of equity, they have about 49 cents of debt. It is very important to understand the debt to equity ratio because you want to make sure a company isn't over leveraged, because if anything goes wrong, they won't be able to pay their debt. It's considered relatively moderate, which means they're not excessively burdened by debt, but it's something to keep an eye on. Clients or many companies have different ratios. Usually growing tech companies don't mind tacking on a lot of debt in order to expand rapidly, whereas solid, well-established companies tend to have lower debt to equity ratio because you want to make sure a company isn't over leveraged. Because if anything goes wrong, they won't be able to pay their debt. It's considered relatively moderate, which means they're not excessively burdened by debt, but it's something to keep an eye on. Though many companies have different ratios, usually growing tech companies don't mind taking on a lot of debt in order to expand rapidly, whereas solid, well-established companies tend to have lower debt to equity ratio. Here's another important detail. The company is continuously offering up to $2 billion in shares. This is called an offering, and it means they're constantly selling new shares to investors. They intend to sell these shares monthly, usually at a price equal to the net asset value per share. One of the reasons a company might want to do this is because they want to raise funds. On April 1, 2025, they received about $7.1 million in subscriptions for shares from outside investors. This indicates that there's some demand for their shares. The report was signed by Monica Kelsey, Chief Financial Officer, on April 4, 2025. I step back and analyze what all of this means. Antares Private Credit Fund is a credit fund, which means they make money by lending to other businesses. They're paying out distributions, which is good for shareholders. Their debt to equity ratio seems manageable, but it's something to monitor. They're continuously offering shares, which could dilute existing shareholders' ownership, but also raise capital for new investments. One of the biggest opportunities for the fund is the increasing demand for private credit. Traditional banks have pulled back from lending to certain businesses, which has created a gap that private credit funds can fill. However, there are also risks. A downturn in the economy could lead to more borrowers defaulting on their loans, which would hurt the fund's performance. Also, the continuous offering of shares could put downward pressure on the share price if demand doesn't keep up with the supply of new shares. Overall, Antares Private Credit Fund appears to be navigating a complex environment. They have a reasonable debt-to-equity ratio. The continuous offering of shares is a double-edged sword, providing capital but potentially diluting existing shareholders. I'd advise potential investors to carefully consider the fund's strategy, risk factors, and the overall economic outlook before investing early. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate decoder deep dives. Let me know in the comments what company I should decode next.